Welcome back. In this video, I want to talk about the importance of staying invested in the market. I want to show you some of the research and study that convinced me to always stay invested in the market regardless of valuation. I'll also share my strategy when it comes to buying stocks and avoiding timing the market. But it's also important to note that I'm investing for the long term, for the next decades. And stick around to the very end to see my entire portfolio and what stocks I bought this week. I made a huge move after the incredible volatility we saw last week. First up, here's the cost of missing just a few of the best days over a 10-year period. The article says, more often than not, investors find themselves buying high and selling low. And when the market starts selling off sharply, investors will panic, sell their own shares, and sit on the sidelines. Unfortunately, some of the biggest one-day upswings in the market occurred during these volatile periods. If we look at this chart, if investors stayed fully invested in the S&P 500 over the 10 years between 1993 and 2013, they turned their $10,000 initial investment into $58,332. If they missed just the 10 best days over that 10-year period, their return was significantly smaller at $29,111. If they missed the 20 best days, their return was $18,140, and so on. The point is that timing the short-term fluctuations of the market can be extremely difficult to do consistently because the market is often irrational, and you're probably just better off focusing on the long term and staying invested. As this next article highlights, even if you somehow pick only the best day of the year to invest versus the worst day of the year to invest over a 20-year period, your returns really aren't that different. The article highlights that timing is not critical to long-term success. They presented two hypothetical investments in the S&P 500 over the 20-year period ending December 31st, 2023. Each investor contributed $10,000 every single year. One investor somehow managed to pick the very best day, or the market low, of each year to invest. The average annual return on that investment would have been 12.64%. The other investor was not so lucky and actually picked the worst day, the market high of each year. Even with the worst investment timing, the average annual return would have been 10.78%. If we look at the results at the bottom of the table, they're not that different. And although it would be nice to have almost $200,000 more at the end of the 20-year period, investing at the very best time each year is just unrealistic. And if you were to just invest consistently the same day every week, month, or year, you'd probably end up with a result somewhere in between those two numbers. This article also highlights that over the past 96 years through December 31st, 2023, 94% of 10-year periods have been positive ones. Investors who have stayed in the market through occasional and inevitable periods of declining stock prices historically have been rewarded for their long-term outlook. And as the data here suggests, the longer the time period, the lower the chances are of a negative return. To touch on when I buy stocks and how I avoid timing the market, it's really simple. I have money deposited into my account every single week, and I buy stocks every Friday, regardless of what's happening in the short term. There's always a deal in the market, you just have to look for them. Now, I personally think it's a smart idea to only invest money that I don't need and I could survive without. Don't get me wrong, I'm currently pretty much fully invested with probably at least 95% of my net worth in stocks. But I live comfortably doing so because I live below my means and my income is higher than my expenses. And that allows me to do two things. One, survive the bear markets, which you can see from this chart are historically not very long compared to the bull markets, and the loss is often minimal compared to the following bull market. And two, it allows me to continue buying stocks when the market is offering discounts. Now, not only is staying invested in the market important, but getting started early is also super important to maximize the benefits of compound interest. Here's a statistic that blew my mind. 99% of Warren Buffett's net worth was accumulated after he was 65 years old. Warren Buffett's net worth was a reported $84.5 billion in 2020, and most of that wealth came in Buffett's later years, with $84.2 billion after he turned 50 and $81.5 billion after he turned 65. And if you didn't already know, compound interest means earning interest on your interest. As your investment grows, the profits you make are reinvested, generating even more returns in the future. Over time, this compounding effect can lead to exponential growth. And that's why if you start early enough, just $150 invested per month with average returns of 10% from the S&P 500 will make you a millionaire by the time you retire, as you can see here. However, if you choose to start just 10 years later and your money only has 34 years instead of 44 years to compound, you'll be left with roughly $441,000. So I often hear the argument that the money someone is investing today is so little that it doesn't make a difference, but clearly it does in the long run. If you're in a position where you can invest more than $150 per month, your returns could be significantly different. In my case, starting with my $70,000 portfolio at age 24 and contributing what I'm currently contributing monthly, $2,000, with average returns of 10% per year, I could be left with just over $18,434,000 at retirement age after 43 years of compounding. But keep in mind, that's assuming no income improvement over the next 40 plus years. And to show the exponential effect of compound interest, look at the red dotted line and the steepness of its curve when I change that from 43 years to 53 years and then 63 years. The point is, the longer your money compounds, the more it will start to make during your later years. If you've watched any of my other videos, you know I don't invest in the S&P 500. I try to beat it by picking individual stocks. So going back to the previous example of a $70,000 initial portfolio, investing $2,000 every month over 43 years, see what happens if I manage to outperform the market by just 1%, gaining an 11% average return over the 43 years. I could be left with over $25 million instead of $18 million. Now, I think you're a good investor if you can achieve a 15% return on average. If I can do that, I could be left with over $93.5 million. If you're as good as Warren Buffett, achieving a 19.8% return on average, that initial investment could lead to over $451 million instead of $18.9 million in the same time frame. I'll leave a link to this compound calculator in the description below if you want to check it out for yourself. But that is why I put in the time and do the hours of research to understand the ins and outs of companies and their valuations and so on. And that's why I believe I've been able to get a 31% return on my money in the last 1 year versus the S&P 500's 21%. However, I'm nowhere close to doubling the performance of the S&P 500 like I want to be doing. So there's still work to be done, and we'll see if I can keep it up in the long term because that's the real challenge. But if you're interested in seeing how I perform over the next few years, subscribe to the channel and join my Discord, link down below. I share the research that I do in there and all the buys that I make immediately. Moving on to the moves that I made at the start of this week, the ELF dip was simply too attractive to pass up, so I ended up exiting my entire Nvidia position and bought over $3,000 worth of ELF and a little bit more of Celsius. I ended up making a small 6.5% gain on my Nvidia shares, but I chose to exit the position because I'm already heavily invested in both AMD and ASML. And I do see both of those as better risk rewards over the next few years and have better potential for outperformance. Also, ELF's valuation with their past growth, which I expect to return in some aspects of the business, the risk reward profile of that company was simply too attractive to pass up. I spoke about ELF and covered their recent earnings call in my last video. So if you're interested in learning more about the company, definitely watch that video. That'll be it for this time. See you in the next one.